Hello, everyone. Welcome. We are excited as we get started with our inaugural live streams today for our financial. Today, we are talking all things taxes, and we are looking forward to covering these topics here about taxes. And we have our guest aboard, and I will be bringing on Mr. Hayward now, and we will get started without further ado.
All right, here I am. Here I
Here
am.
he is. You
Yo,
just
this is
hey,
nice.
you just get out the gym. You looking like you just got out the gym. I didn't make it today, so
Yeah,
uh,
I did go to the gym today though. Actually, I did, but I've showered and I'm all right now. But I'm here. I'm just enjoying the fact that like I can just talk. I don't have to, you know, manage the live stream.
yeah, this is new for you. So for those of y'all who don't know, yeah, Hayward CPA they have a stream that comes out every other Saturday morning. So
Yes.
make sure you guys tune into that as well. Really good topics, and I've enjoyed being on his show as well. So it's been a lot of fun. Um, but today we're here to talk about taxes a little bit. So for James and I, both of our benefit, we'll throw up our little disclaimer that we got to throw up to make sure everybody understands. You know, we're just here to talk a little bit.
Having a chat. That's all.
Having a chat. Please consult your professional for specific information, or one of us. We'll be glad to talk to you. But yeah, without further ado, we're gonna jump on and get started here. So
Let's go. Let's go. Let's do it.
yeah, let's go. All right, so we're gonna start off talking about tax dollars, how we spend our money here. So, I mean, many people probably don't know how that money is actually spent. The big three ways that we end up spending those dollars. So that'd be interesting to share that. Let me get that PDF pulled up so you all can see that as well.
I like you. You got oh man, this is beautiful. You got like collateral.
Yeah, I have real live data.
Yeah, you got yours is okay. All right.
All right, here's the breakdown for us. 2021. We spent 10% of our tax dollars on Medicare.
Hmm.
Next, 11% on defense spending, and the biggie 1.1 trillion on Social Security. So we can kind of see why that has become a concern for many people, and how we're gonna keep that going. Um, so I just want to start with some fun facts to kind of get us started as we titrate down. But how's your tax season going so far? Get kicked off
Ha,
okay?
ha, ha. It's so I mean, it really will start tomorrow because that's when everybody theoretically should have all their forms. Theoretically. But
Theoretically,
it's going. But it's gonna be better because we don't have the advanced child tax credit or anything like that this year. So we good. We
yeah,
good.
that should help out a lot. Should speed it up so IRS doesn't have as many things to check. People don't have as many things to check for.
Or
Thankfully. So
forget. Or forget.
yeah,
That's the big part. Like,
yeah, true.
did I get I got $3,600 in my account. Oh, that's what that was? Really? Like, yeah, really? Oh, okay. So yeah, but it's going good. But that slide you had is very, very compelling. It's interesting.
Yeah, yeah, yeah. So now back to something else. We do have one more little tax hold up too with North Carolina. I think I was reading today they're not accepting returns until Friday.
Oh, well, I
Yeah.
mean, that's all right.
So, prepare. If you can hold off to Friday, you won't have to go back in and file twice. I've already filed some. And I have
Hmm.
to go back and file North Carolina on Friday. So,
Yeah, yeah.
you know, kind of
You
used to do
you
it.
already in the mix. You're in the mix.
Yeah, I got a few people beat the door down already. We done got going. So
Oh snap! Yeah, nah, we we're getting that up. We're getting that up and running right now. So that
good,
yeah. Oh, I
good.
think Corey he said he's in the
Is
waiting.
Corey
Yeah,
trying to come in? Oh, I see him. All right, hold
yeah,
on. All
yeah.
right, there he is. There he is. We got Corey too.
We got the three. Okay, and I'm in the middle here. That's
Uh-oh,
cool.
yeah. So now we got the guy who kind of keeps us calm down when our keeps us focused on strategy when we get going a little too far. So we
Yeah,
got
because it might get real tax geeky. It could get real tax geeky real
Can you
quick.
guys hear me?
Yeah,
we
we hear you.
can.
Okay, cool.
Yeah.
All right,
Oh,
Yeah,
cool.
we can.
I like this with the slide. The slide is
Yeah,
dope.
Yeah.
This is
yeah.
let's talk about it. I'm on it. I'm
All
in.
right. All right, James, let's get into it. So tax brackets. All right.
Yes.
2022 tax rates here. We got our brackets. Um, what when you're talking with clients, anything in particular that stands out to you in terms of brackets, and when you're talking with them about strategy, just trying to make sure they understand the brackets, how they work, things of that nature.
Yeah. Well, I mean, the first thing about our tax system is a progressive tax rate. So, one misnomer is that, for instance, let's just look at the 37% tax rate
Hmm.
that all our clients we have that are in that rate. Since we all our clients up there like that, right?
Right. Right.
Many people believe that their taxes are for a single person is 539 times 37%. But the way the brackets work is, if you see each one of those brackets, you pay that rate up. So if your taxable income is 10,275, you pay 10% of that. Then there's a difference. So it's progressive. It's not
Hmm.
simple like, oh, I made 500,000. Oh, I gotta pay 35% of it. That's one of the
Correct.
first things to understand. Secondly, is to understand that this is taxable income. So this is not necessarily your gross income. The gross income comes in, is adjusted, not as many adjustments as we used to have, but is deducted, and you get down to a taxable income rate. What I will say is that um the taxable income and the total tax, that's where the tax planning needs to look at, not just at where your refund or what you owe. It's about the total tax that you owe. That's what if you're trying to do some tax planning, you're trying to reduce the taxes that are calculated, not your refund or your oh you oh we I guess we could get into that a little later, but that's just one of my little pet peeves that
Yeah.
people miss.
No. Yeah. No. Now it's funny you mention that, because a lot of times we have clients who with their W-2s kind of get stuck in the sense that they filled out that W-4 properly, merit zero,
Yeah.
but they really don't understand how that payroll tax table works. And essentially the IRS really isn't concerned with whether or not they take out the right amount of taxes for you.
Oh yeah, totally.
And that table kind of under withholds on purpose, I think, because they think we're going to have the big house, have the big mortgage deduction, and a
Mm-hmm.
lot of people don't have that, and now we're upside down when it comes to tax
Yeah.
time.
Yeah. And that's where your estimates come in, if you work with your preparer or
Hmm.
practitioner to look at tax projections.
Hmm.
So it's a thing when you get to the end of the year, you may owe. If you're okay with it, you're gonna owe. Put the money. Okay, cool. If it's something that you're like, I don't have the discipline to hold on to this money, you might want to look at doing, your estimates. Based on the prior. A lot of times you base it on the prior year to get out of certain penalties. But make your payments, and nothing precludes you from making a payment monthly. By the way, even though the estimates are due quarterly, you could, in essence, pay monthly and
Hmm.
go there. I think it happens a lot with single people that become high earners, and especially if they get bonuses or they exercise stock options. That's usually where it really throws them off, because they get an
Hmm.
extra 20, 30,000, and they're like, oh, what happened? And
Yeah.
and then they're like, wait a minute, I withheld so much. But remember the brackets, it's stacking amounts on top of each other. And a bonus or stock option or something can slide you up to another bracket, and just by itself, it pushes you up. So yeah, that's
Y-
it's nuance, my friend, nuance.
Right. Yeah. Another place I see it is with certain industries like nurses.
Oh
So, you may have a nurse who works at UNC, works at Duke. So those two payroll systems, they don't understand that those payroll systems can't see each other.
exactly,
And
Exactly.
so to back up to our brackets, you know, you got two checks and they're falling in this 41 to 89,
Hmm.
which tells you, 2022. But if they're both 50 or if they're both 88,
Yeah.
now you're at 176. You done jumped up to the 32%
32%.
bracket.
Yep. Yep. Yep.
And
And
that kind of tends to get involved too. Corey, how do you see things working with people a lot of times and trying to help them with strategy? Because you're more that strategy, that forward thinker, kind of getting us down the road. That's your role for us.
Hmm. Really, I focus on breaking things down to the lowest common denominator, right? And the lowest common denominator mainly being, let's start with understanding. What is it that we need to understand that we can deal with? And when I'm able to unpack it that way, it allows the room for the tax strategy and the tax planning to take place. Because a lot of people come to us with, we need help reducing our taxes. Do you do tax planning? And when the question is asked, what does that even mean to you? You hear statements like, I don't want to pay the government. I don't want to pay too much in taxes. I don't want to get in trouble because I'm doing something wrong. Right. And so when you lead with fear, you actually move understanding out of the way. And when we replace it back with understanding, now we can get back into strategy. And then that strategy leads into, I have this word grow, right? So what are your goals? What are your current realities? What are your options for improvement so we can figure out a way forward? Does that make sense?
Oh, love it, love it, love it. Thanks. And that's what we said, like gets us down the road.
Mm-hmm.
Um, all right, so we're gonna jump back on the geek side for a minute and
oh yeah, I got
let's
my
talk
geek
about
book with me too.
yeah, yeah.
I
All
got
right,
my
so
book here. We can go. We can go deep.
oh boy. All right. So James, let's back up because a lot of people 2017 Tax Jobs and Cuts Act, this standard deduction jumped up, itemized, and it kind of, hurt real estate and charitable companies and your churches and things of that nature
Mhm.
because it kind of impacted taxes here. So, as we have these standard deductions up 2021 versus 2022, so we're 2022 now, 25.9. A lot of people aren't itemizing. Um, and my specific question really is like one around real estate, right? So now you bought a house, and in old tax law, you wrote off your mortgage interest.
Mhm.
Now with we got to get over 25.9 with all
Yeah.
those three things. What how are you counseling your clients when we're trying to package how to take advantage of those deductions?
Well, the way I package it, since the infamous Jobs Act, because that's what it was, the jobs from
Hmm.
that's what he was calling it. There's something that I think is overlooked in tax administration, and that's the cash flow effect of tax.
Mm. Hmm.
So, it's easy to look and be like, well, you mean my house? I mean, well, to take it all the way there, like, because we've taken away the exemptions. So technically, your kids, the way we used to say you claim someone, you don't
Hmm.
really claim anyone anymore. But that was a hard thing to swallow. But as in it affected the standard deduction too. So my thing is always like, look, you know, you gotta, you would have to have over for a married couple 25,901 for it to have any effect on you. So that $1 to have one effect. And you got to consider, do you want to, you a lot of times with tax strategy anyway, do you want to spend the money just to say you're getting the deduction on there? What they're trying to do, this is the example of simplifying the tax code. This is simplifying it. So
Hmm.
no, if you bought your house, and this hurts realtors because they always would tell that, well, it's a tax deduction. Well, yeah, no. For most people, it's not. In low property tax, low local tax states like here, your tax, our property taxes for the most part are not, we're not hitting the $10,000 cap. Like you would have to have so much stuff to get over to itemize that
Exactly.
you would be spending so much cash. And this question, how much are you saving on tax? I mean,
Okay.
you, you know,
Thank you. Thank you. All right. So back up for a second. All right. So that question right there, I know you get that question. You present a person with the tax return.
Mhm.
They want to pay lower taxes, and then they go, "Well, if I give to charity, what happens?" So let's assume for a second we're over the 25.9 and we are
Okay.
itemizing. We're gonna get over
Okay.
the hump here. And I give the charity back that answer up into that cash flow
Yes.
conversation.
Okay. First off, is that in these deductions, they're not dollar for dollar. So we get over if you pay 10,000 based on your bracket that we talked. Now I'm doing this real simple.
Yeah.
10,000 may, let's use the 22%. 10,000 would reduce, and it's not dollar for dollar. It's gonna reduce your taxable income. I think it's like 22. It's gonna be $2,200. So you're gonna put $10,000 with $2,200 in tax savings to keep it simple. The question is, and going giving to charity is good. If you want to give the 10,000 to the charity, by all means, give it there. But to
Right.
tell me about the tax savings, do you want to give $10,000 to say that you're saving 2,200? Or you want to keep the $10,000 and pay whatever tax you got thus far, and possibly I'm a jump invest the
Mm-hmm.
10,000 and get you 6 to 8% of the year. Is not. I think what happens is so many people come from when you're younger, first job, before you're married. It's all about getting the refund, man. Like that.
Mm-hmm.
And if people grow up and they still in that frame of mind and they start making money and they still chasing the refund, and I say this in business a lot too. The easiest place to claim that your money is going to is taxes. People don't like to say that they spending money on something else. Like their thing is I could save on taxes. Well, you can save on your utilities. You can save on your Starbucks habit. You can save on a lot of things. So, but the saving taxes, it costs money. So
Mm.
if we want to say, yeah, well, can I give more to I love it because we get it. I want to give more to charity. I want to do. You be like, okay, yeah. Then they tell you how much. Well, that didn't take it down much. Oh, certainly did not.
Right.
It's
Right. Right.
you're only every dollar you're only getting a percent of that in tax reduction.
Mm-hmm.
To keep it simple. So once again, tax strategy. I we say this a lot, and Corey, he's heard me say this on calls. I mean, it's real simple. If you don't want to pay any taxes, don't make any money. All right, that's number one. Just don't make no money. You won't pay any taxes. Perfect, right? Foolproof. The next thing is that I always tell people that strategies in isolation are no good because, as you know, we can look at the return and be like, oh well, if you boost this up, like if you just take one strategy, even if we do this thing with the 10,000 with the charity,
Mm-hmm.
you would reduce it, but you might still owe $8,500, and now you don't have the 10,000 to to pay the taxes.
Right.
So I think there's more. He is trying to be more holistic, and
Mm-hmm.
the way the tax code is constituted now, if you're a wage earner, I mean,
Yeah.
it's
It's not
it's set
much.
up. Yeah, like just it's set up to do your thing. There's some things in there. Don't get me wrong. There's some things, but for the average person, you're gonna have to come up with a lot of cash to reduce your taxes. A lot. A whole
So right, and I think we hear this a lot too. And then I'm a pivot over to Corey too from the hobby business where somebody goes, "All right, James, I'm gonna start a business,"
yeah,
but it's the same conversation.
yeah, that's
All right,
true.
you're gonna spend $3,000 to save $1,000.
Yeah,
No, the
yeah,
purpose of business is to be profitable
exactly.
and to pay taxes, or we'll get down the road in a minute on some other some ways to move that money versus spending it to save taxes. So we'll get there.
Excellent.
But let me pivot over to Corey with because Corey works more again with businesses and strategies, and in that we when it comes back to taxes, we kind of get into a lot with purchases and equipment purchases and needs and things of that nature. So I'm gonna let Corey kind of take that conversation, but it leads back to this same premise that we'll talk about. But yeah, Corey, again, that big strategy. I know you used to work with dentists a lot, and that's where I have that question quite a bit with my dentist.
Yeah, so it's you can say, let's use the word discipline, right? And so discipline is compounding. It can be very vague, right? And when you get down to the nuances of discipline, then you say, okay, well, what does that even look like? Um, I guess the same is the same is the same. It comes down to perspective, and then it comes down to what you want, what you're looking to achieve, and then what is the vehicle that you're using to get there. So when I encounter folks that, either they want to start a business or they have started a business, and they are they're good at what they do, right? Technician wise. Um, Really what it boils down to is systems, right? Save yourself some time, energy, and money. And it's the systems that you use as technology based. It's the systems that you use as an individual or person. It's the systems that you put in place for staff development. It's the systems that you put in place to move your clients through your whole process, through your organization. So it's kind of, again, it's the same when you're looking at how taxes play a part. I have I'm on the inside of obviously a lot of tax conversations, but essentially, James and I talk about this a lot, and we put kind of things in place. Is they may have came in with a tax question, but that's not their problem. Their
Mm,
problem comes from management of selves and then implementation of different systems, processes in place. The tax conversation becomes way lighter at the end
oh
because
wow.
most people because of the fear and the misunderstanding that tax, you start a business to pay the government. No, you start a business so you can do what you want to do, basically, and have the money to do it, right? And you work on your own time. So that's, the same is the same as the same. It's perspective, it's goals, it's discipline, and ultimately leads to what systems you have in place.
Awesome. Oh, that's good. That's good. Um, all right. Next two topics. So,
Okay.
James, you mentioned how deductions don't result in dollar for dollar,
Mm-hmm.
but what does result in dollar for dollar reduction of your taxes?
The infamous the tax credit.
The tax credits. So we need credits. So let's talk about credits, as well as a lot of people want to understand how real estate professionals are able to reduce their taxes and the rules they have versus that regular old S corp, things of that nature. That's that's really important. So they have their own set of rules. So let's
Yeah.
let's talk about that a little bit.
Yeah. So, well, I'll start with the tax credits. I mean, tax credits are, I mean, the Congress's way of doing a lot of times is social engineering. You have the child tax credit, earned income tax credit. There's a plethora of credits, the education credits, things like
Mm-hmm.
that. What makes a credit more valuable in the environment than a deduction is that the credits are applied after the tax is calculated. So so if you have a $10,000 tax bill, the credit is dollar for dollar. It
Mm-hmm.
reduces the tax as opposed to a deduction reduces your income before the tax is calculated.
Mm-hmm.
So that's why, if we like credits. Um, Rolling to the real estate thing, the
Mm-hmm.
holy grail, the gateway to everyone's prosperity on the planet. Everybody. Go ahead, do real estate. So there are differences and there are nuances. Especially now, professional real estate professionals. And you could correct me, Marcus, for my exact numbers, but I know they're required to spend 750 hours
Yeah.
a year at
Hmm.
minimum on real estate activity. Now that somewhat subjective, based on who's doing the return and all that. So you break that down. Look, that's over 50 hours a month, about 60 hours a month with real
Right.
estate activity. Now, if you renting your old previous residence and have a property manager, you're really not a real estate professional.
Right. Right.
Like I mean, you're not. And we'll get to what that means. You're
Hmm.
not spending the time on it. Now, what time can mean, um, can look at obviously managing. If you don't, even if you have a property manager, you can be fixing do your own repairs. And, in most cases, you're looking for new places, you showing places, you are in the business of real estate. Okay.
Hmm.
You rent in a house that is called a passive activity. And so
Hmm.
most of us, if we doing is passive because you got a full-time job. You got a full-time job. And then you got these, even if you have multiple properties, you got them. You're not spending 750 hours a year. The Where the difference comes is that your losses will be suspended. So most rental properties, especially in the early stages, take losses because because of depreciation. Depreciation, which is also the recapture. So you pay $300,000 for a house. You're not going to deduct $300,000 in 1 year. You recover it over time. Residential real estate, 27 and a half years. You recover it over those 27 and a half years. In many cases, most cases I've seen all the years, it creates a loss. It's a paper loss, which is why rental real estate is such a great tax strategy because it reduces your income because of the depreciation loss. But guess what? You still got to buy the house and spend the money to pay the mortgage. I mean, it's not that, but that's the main thing. But if your losses, if you're not a professional, no, well, they and then there's the 25,000 thing too. Let's just keep
Hmm.
it simple right now. If you're not there, your losses get suspended, and it has to do with certain things. So that's where you're not a professional. Now, then they have this other thing because I think the 25,000 is irregardless if you're a professional or something like that. If you're not a professional, there's a cap at 25K in losses.
Hmm. Right. 25 a
Yeah,
year.
so you
Right.
could you could take up to 25,000 in losses. Well, if you're a professional, you take losses, you get all of it. Take all of it.
There you
But
go.
without that, you get up to 25,000. And some people, when you start getting into income levels, you can't take none. This is losses are suspended and they're sitting there. Um, so that's where the power is in rental real estate. Now, now what happens when you start making a profit?
Hmm. Hmm.
That's always the trick. So when you had the profit long enough, you start making a profit. And that's
Hmm.
when people kind of get a little, oh my God, what do you mean? Oh, well, listen, you've been taking this depreciation all these years, taking the L's. Now it's showing a profit. But remember, all those years when you're taking a loss, you're cash flowing. Your cash flow is what it is.
Hmm.
So if you're collecting $12,000 a year, but your book is showing the rental property as being a loss at 8,000 a year, you're not paying any tax on that.
Right.
Because of the depreciation, you got that. So that's why I say none of this stuff is in isolation. And then do understand if and when you sell the rental property, you're gonna have to pay something called depreciation recapture. So all
Hmm.
those years when they were taking depreciation and was deducted against the ordinary income, when you sell it, part of the calculus is adding that back into the game. So It's not, people think it's so easy. Tell you, it's so simple, but because it's easy to get into, though. Like resident, you
Hmm.
buy a house. I'm in real estate now. I love that, man. There's so many people. I'm in real estate. You rent your house out, dog. But anyway, I'm snarky, but but people really gravitate to. I will say, I think I get kind of off because there's some people that like that's their business for real. They do it for real, for real.
Oh yeah, yeah, yeah.
Like they do it. And but it's a good way right now. It's probably one of the best strategies for just looking at a return, and the structure of a return is one of the best strategies still for reducing your income without. I mean, there is a cash flow outlay in the front end, but it's not like an IRA cash outlay or something. It's one of the
Hmm.
best ways to go, but it costs money too and time.
Hmm.
And some people don't want to, if you got a high
Right.
powered job, then you got this rental property and you like, man, I'm not trying to deal with this. So well, it's cost benefit. It's always cost benefit. Always that. Always cost benefit. Always that.
Correct.
You know what I'm saying?
All right.
So
Yeah. So I want to come back to that piece about you mentioned isolation a lot in these strategies. So
mhm.
we're going to come back to that when we get to that point. But let's talk a little bit about, because we have a lot of people you mentioned going into business.
Mhm.
A lot of people really need to understand too that the business structures, both from a legal side and a tax side. So we hear LLCs and LLPs and S corps and C corps and this, that, and the third. So I want to kind of hit on, that there is a difference between legal and what you tell the Secretary of State, and then that how you can tell the IRS exactly how you want to be treated, and then what that benefit is of when we do C corps, when we do S corps, and what that S corp advantage is versus that sole proprietorship.
Whoa, hey, this is heavy. Let me pull out get my literature out here.
Hold on, water break.
In case,
Water break. Man, hold again.
in case you're
Water
having a
break.
hard time sleeping at night, check this out. I got something. I got a lullaby for you right here, Master Tax Guide. That's what I put you out there. You better than any melatonin you can ever find. So, so okay. We talking about entity structures. You're starting businesses, yes, and people are doing it. They're doing a lot. The barriers to starting a business now are lower than ever. People are taking advantage. They're doing it. So let me tell you, in terms of tax entities, they're basically we'll say four, three, four, whatever. Sole proprietorship, partnership, S corporation, and C corporation. Those are the four entity types. Um, you may form your business as a LLC, but if you're the only member, it's something called a disregarded entity by the IRS. You're still a sole proprietor. Doesn't matter. You could. I'm an LLC. Okay. Well, you're a sole proprietor. That's what you are. And the LLC, in that case, well, especially when we're advising clients, it's about, hey, that's more of a legal protection when you're a sole
Hmm.
proprietor because tax wise, it makes no difference to me. It
Hmm.
does nothing. So that's the basic thing. So if you just start something, get an EIN number and do it, or you go form a LLC, one person, single person LLC, you are a sole proprietor by definition. Or when you come in the door, come see Marcus, come see us, you're a sole proprietor. We'll get into how that adjusts down the line. If you have more than one person, you're a partnership. LLC could be a partnership, non-organized LLC. You got limited partnerships. You have a whole bunch of partnerships. More than one person, you're a partnership. That's a form you file. And that, incidentally, one of the more complicated tax situations that you ever come across. You would think a partnership, me and you 50-50, we're all good. Lemonade stand, get half, right? No. And it's good because there's a lot of it gives you a lot of flexibility in how you conduct business in a partnership. That's in the 200 level cost, but it does give you more stuff, right? So that. So then you move on. I'm going to go to A C corporation. C corporation is a corporation. You have filed as a corporation with your state. Is a C corporation. That C corporation pays its own taxes. It's I mean, Mitt Romney, corporations are people too. He went a little far with it, but it is its own entity. Um, it has its own situation. If you're doing tax play or something, it's for that. There's an advantage to that. It's certain income streams that might be in the 300 class, but we can get back to that. And then there's, just like the LLCs have been hot things, because LLCs are relatively new. I think the state started adopting them in the 70s or 80s. They were new. The S corporation, which people like to call small business corporation. So, okay, S corporation is for a subchapter in the IRS code. That's what the S corporation is for. And it is an election that is only recognized by the Internal Revenue Service. You have to take an election to take your your sole proprietorship, your partnership, or your C corporation, and elect to be taxed as an S corporation. So you have to elect it, and the IRS has to approve it. And once it does that, your entity is not responsible for tax. Like the C corporation become an S corporation. All the tax happens at the taxpayer level, just like sole proprietors and partnerships. I apologize, I missed that part. Haven't done this lecture in a while, but so just like those two, that's what it does. So it's advantageous because NC doesn't pay taxes, and there are things that the biggest advantage is that your partnership and your sole proprietorship are responsible for self-employment tax, the dreaded 15.3% that none of your deductions work on. Whatever your net income is in your business times 15.3, that's what you owe, period. It goes to the bottom of the form. That's what you owe. There's a hocus pocus. Nope. You can go borrow kids. You can do whatever you want for your return. You paying that 15.3. All right. So what S corporations do, they remove that need. So, and the way they do it is that they require you to have a reasonable compensation, basically to get a W-2 paycheck, even if you're by yourself. So let's just say you got that LLC, single member LLC. You say, I'm going to be an S corporation. You know why? Because Marcus told me to. I'm going to be an S corporation and I'm here. Okay. S corporation, I have to take a paycheck. You could take it once a year. You can take it once a quarter. They don't tell you got to pay. You got to take a paycheck. So you got to take a paycheck with a fair, And now there's no IRS guidance on this. There's nothing that says reasonable compensation is this percent. No, it's fair. It's a reasonable compensation. Excuse me, not fair. So you have to take that. So what happens is, let's just say you have your business, your sole proprietorship, and you got $100,000 in profit before we do your salary. Okay. We're going to take 20,000 as your salary, and 80,000 is going to flow on through to your 1040, and you're going to pay tax on that. Well, what the advantage is that with us, that same LLC taxes sole proprietorship, we would take 100,000, 15.3 right there off top. By being an S corporation, we're going to take 20,000 running the payroll. Let's just call that, you're going to pay $3,000 in taxes for that. And that $80,000 is going to come over, and you're still going to pay tax on it, but you bypass the 15.3. You don't have to pay the 15.3, and it can play with some of your deductions and stuff. And that's where the planning advantage is with an S corporation. That's where, but the thing is, you have to be on a payroll, and you have to pay reasonable compensation. And I think it's important to understand that now, because these 80,000 stormtroopers that they're hiring at the IRS, I don't know how many will be agents. That's a place where people are getting over, and I believe they're going to start examining that along with basis. Like I said, that's 200 level, but that's they're going to start I believe because it's I mean there's some recovery for them there. I think there's
For
some
sure.
stuff when people playing over there. They I've seen some stuff people doing like 200,000 and they pay themselves 10,000 in salary. Something crazy like that.
Yeah, yeah.
It's reasonable. It's reasonable.
Right, right.
Okay,
But
dog.
like I said, that essentially that's the goal is to. It's funny how our earned income is taxed harder than your unearned income.
All
So
day,
the
every day.
trick, yeah, the trick is to kind of turn income into investments, capital gains in real estate, things of that nature. So that's the
That's
trick.
true.
All right. So before we get to the isolation, let's I want to get both of you guys' viewpoints on two things. Um one, as you called it, the Jobs Act is
It's supposed
set
to
to
expire.
expire
Yeah, so this
2025, right?
yeah.
Okay. So do we think it's going to expire? And two, what do we think will happen with tax rates 2026?
Woo! I don't know, Corey. I've been
And
talking. I'll let you go first. Just what you think. Pick it apart how you
Run,
want to.
run,
Run, run.
run,
we need to move. We need to move out the
Again,
country.
run.
some
it's it's fun. That's a loaded question because it can work. It can work both ways. It can really end up really bad, or it can end up really good. Um, I think seeing what 2023 has to offer and the plans for 2024 will determine preparation for 2025, 2026, and beyond.
Hmm.
If I just keep it, really simple in
Yeah.
terms of, you know, um,
well, I'm
It's
saying, well, let me
mhm.
just I'm gonna throw in as a taxpayer yourself, how do you feel about it? I guess that's a great way for you to answer it.
I don't feel good about any of it. If I'm being honest,
Yeah.
uh, uh,
right? As a not only just as a taxpayer, but having some understanding of what taxes are, and as long as I've been within the tax industry and business development industry, and not having those credentials at the end of my name, it's still I don't like it. I enjoy the understanding and the strategy of it. Like I love it, but it's a lot that you have to pay attention to. So it's a wavering. You could create a plan this year, next year that plan
oh yeah, yeah,
changes.
yeah. True,
You
true.
understand what I'm saying? So yeah. So to answer your question, as a taxpayer, I don't feel good about any of it because it's
Right.
way too much.
Is it seemingly the thought though that based upon COVID, we'll say if we take COVID, PPP, loans, stimulus, all that stuff, I think we bumping our heads on the debt ceiling. Um,
Yeah. Yeah.
so does that kind of lead us to think 2026 these rates probably got to go back up?
Yeah, absolutely, absolutely. Now the whole pandemic, it brought people out running all over the place.
Mm-hmm.
I mean, we run across people they haven't filed in 6, 7, 10 years, 12
Yeah,
years.
yeah.
Right, I need to file so I could get some of this money, get a PPP loan, get some of
Yeah, yeah,
this
That's what it
pandemic
was.
check, right? And then the year later, people are getting CP 2000s and all kinds of liens on their property, and I mean it. So that's what I'm saying. I don't like it. It, it doesn't add up. If that makes sense.
It's
It's
a
like,
little
wait,
hectic out
I'm
here.
doing all of this stuff, and then I have to still, whether I'm a CPA accountant or not, I still have to have some sort of discipline to do it. and understanding around what's being done for me if I'm not doing it myself.
Mhm. Mhm.
All I'm saying.
Mhm.
So yeah. Oh, okay. I guess my turn, huh? Um, but you asked for it. Here it comes. Um, so here's the thing. I'm on the 2023 cuts. That's a tough one because of the way that the legislature is set up. Um, you know, I think it's going to stay the same, and it's according to how strong that the realtor lobby, to be honest with you,
Mm.
is according to what they are able to do because they're suffering now. Interest rates are going up, so you
Mm.
know
Mhm.
that's gonna be. So we'll see what who gets to who. Um, I mean, because just as a side, and then we know this isn't the thing, and then we're dealing with two sides of the same coin. All right, so let's just we get in tribes when we want to election time, but when it gets to governing, you got two sides of the same coin, and they got different philosophies on there. When you get away from all the foolishness, so um, I think they're going to keep it, but my main thing, they're going to keep some of the stuff. I think really what we talking about these standard deductions and itemized deductions and the exemptions.
Mhm.
I don't know I don't know how they really go back. You know,
Right. Right.
I really don't know how they go back to it. I just
Mhm.
don't know. Now, one thing that happens in tax administration, to your point, Marcus, is they can raise the rates without actual money. So for instance, they could boost the itemized deduction and raise the rates, and the effect is net. But they could say they raised the rate, like you know what I'm saying? Like
Mhm.
they
Mhm.
play
Mhm.
games like that, like
Mhm.
or they could lower the rate and lower the itemized deduction, and actually end up with more tax revenue theoretically.
Mhm.
So yes, I
Exactly.
agree.
Exactly.
Yeah, I mean, that's it.
Exactly to my point. Exactly. This is what I mean. It's
Yeah, I
work no matter
mean,
how you look at it.
yeah, it's a thing where I don't know. I just don't know. And it does play into, even though I mean, Democrats like the tax and spend, Republicans like the untax and spend. They both spend. No, don't get it trusted. They both spend.
Mhm.
The political environment so crazy, but man, I don't know what 26 is. I tell you, like, just personally speaking, I'm prepared for them to be ridiculous. Like when we are, I mean, we could get into retirement and my beliefs on that. But when we that age, I don't know what the tax rate gonna be. Heck, realistically, we might be out here like what was my man Total Recall, and they taxing the air. Like they'll just start consumption taxes. Like you breathe too much air. It's like there's a mill rate on how much air you breathe, or there may be a federal tax rate on energy, or like electricity. I don't know what, but somebody got to pay for this stuff. You you know, and the ultra wealthy, they say, well, we pay enough in taxes. We create jobs. We do that. No one wants to pay, right? So, but I don't know how they get, because they can't get elected raising taxes. That's the whole point. So
Right.
I don't.
Right. Right.
They all know. So and then we got one side. This is what I also say with the House of Representatives, which is hilarious. The House of Representatives takes on the IRS. What that I want people to understand. That's like you having an enforcer and then telling everybody that your enforcer is the enemy. But you're the one who empower. It's you. All tax bills start in the House of Representatives. If you guys wanted to abolish taxes, you could abolish taxes in the House of Representatives. They're lying to you people. They know, they just telling you this, and then they throw the IRS out there as the dog. The IRS does not make tax law. The House of Representatives, it starts there. So you notice how all House reps are always talking about the IRS, but the
Mm.
IRS is their goon.
Wow.
So I mean, so okay, yeah. So what? I have no idea, man. I honestly do.
Okay.
I have no, because I'm just
All right.
like, how you want? But something's got to give.
Right. So all right, back to our silo then and our strategy, right?
Hmm.
Have you guys seen with clients a lot this question quite a bit. So Roth versus traditional. Roth IRAs, traditional IRA, in my 401k. Should I do Roth, traditional combination? Um, I know my side, I've been kind of trying to say, I know taxes will not be any lower than they are today.
For sure.
So um,
For sure.
so we've done a lot with encouraging people to consider that Roth side. So like you're saying, by the time we get to retirement, I don't know, the rates could be 60, 70%. Who knows?
Who knows?
But we need that taxable, that tax-free money to balance out trying to manage, how much of your social security becomes taxable,
Yeah.
trying to keep that under AGI, all those things.
Assuming
So
that it's still there.
right. So you guys have had a lot of those conversations as well. All right. Last one. Um, I know we talked about I was hitting Corey with that dental question. And your dentist comes in crying about taxes, right? Corey, I made a whole bunch of money this year. And they go, I want to buy a CEREC machine. And Corey, you go, do you need the CEREC machine? No, I don't need it. I just don't want to pay these taxes. So it's back to the what? Cash flow statement, right? Cash flow question. You're gonna spend 100 to save 30.
Yeah.
All right. Now, my thing is on that piece, instead of us spending the dollars, do we have a retirement plan? Do we have a profit sharing plan on top of that? Let's move that excess $100,000 that we were going to spend, share some of it with your employees in the profit sharing. A good planner has positioned that profit sharing plan such that you're the owner taking all the risk. You're gonna get the bulk of that profit share money. We're gonna run them formulas in the
Hmm.
background so that that business owner gets the bulk of that money.
Hmm.
Um, and now you come over and there's some other advantages too, how you can turn, hopefully QBI doesn't go away, right?
Yeah.
All right,
Yeah.
we had our dentists who were bumping up against that threshold of whatever that number was, 330, 340, 345, but they made 500,000.
Yeah.
Well, hey, you move that 100 over, you can have a double impact of getting that AGI down under that QBI. Now you got a 20% tax deduction. So it's all, that's why people we gotta get in. Like these two guys are great, and I'm glad they joined today to help understand that strategy and us getting ahead of this thing as we're trying to go forward.
Yeah.
Um, but yeah, I mean, we did it. We covered everything in the that was on the agenda.
Oh, yeah.
Uh,
Yeah,
Well,
yeah, yeah.
I'll just add padding to what
yeah,
you said.
I want y'all to jump in and finish it out for me.
Yeah. Well, no, in the Roth thing, what um there's a lot of people that don't understand what a Roth is. There's still a lot of
Okay, yeah,
people
yeah, yeah, yeah.
they don't
Define that for us.
they don't get it. Yeah, so they don't know that a Roth is funded with after tax money, but hereby it grows tax free. And you put security, for the most part, people put securities in there, stocks and bonds, and I'm sure they got some self-directed bananas ones too, but
Hmm.
you put those in there and they grow, and then when you still have that same you can't withdraw it to a certain age. But well, you can. This
You
a little more
can. There's
complicated.
some rules in
Yeah,
there. You
you know what I'm
can,
saying?
but yeah.
But in
Ideally,
theory,
leave it in there for
yeah,
5
you
years.
leave it there until your retirement age. But the money, when you take the distributions, they'll be tax free. The earnings, everything will be tax free. So
Hmm.
great vehicle. And one thing that I know, um, that I've read and spoke to plans about is that because of the nature of them, there's a 5-year waiting period. So you can, with your contributions can be taken out after 5 years. And
Hmm.
people suggest often to get one for your child as young as possible.
Oh
And you
yeah,
put
yeah,
it in
yeah.
there, you could put money in there, and when you pull the money out, the earnings will stay there and still accumulate. So that's another, I know that's in the 300 planning
Yeah,
class.
we'll have to come back and do the 300
Yeah, we go
class.
with that. But they're good. But what it does is it hedges against the tax rate. So we don't know,
Hmm.
because we don't know what the tax rate is, we're hedging against it. So things won't be you may blend it, so if we do have a higher tax rate, maybe it's 3 to 4 points higher, but you're able to get this tax-free money, you may equate it to be similar to where you are now. um
Mm-hmm.
but it takes planning. You have to talk to professionals and people that don't get out much and read books like this, and whatever y'all got in the CFP world, and people that are in it to kind of invite and listen to them. And then in terms of the what you mentioned, the shift in revenue, major tax planning method, shifting revenue. We could get into the accounting ways of doing that, but yeah, what you
Mm-hmm.
mentioned
Mm-hmm.
is more holistic, but you have to have a bigger lens to be able to do those things. Well, if you have a business and you're collecting money and it's just, hey, I want to be able to just spend all my money. Well, you know what? Sometimes it's just, if that's what you want to do, I tell people just pay the taxes and go do whatever you want. Your number one goal, in my this is my rule, and this is I Hayward CPA thought process is, our goal with the IRS is for them to leave us alone. That's what it is. Leave us alone. We don't want you to leave us alone. That that's it. We want to pay. If you want to get biblical, we can render to Caesar. Listen, I don't want to hear from them. All right, that's I don't want to hear, especially if you're in business. Don't want to hear from them. I don't want to pay any more than I should.
Mm-hmm.
I don't want to hear from them. And that's one of the best things you could do as an individual. You don't want to hear from them. It's easy to go ahead and there's so many tools out here for you to really um you know move your money, do more with your money to make it work. And my final thought is, I believe that the financial system is becoming so complex now that I don't think you could put your head in the sand like we used to in the past and just go with it. I think you have to be proactive now. You got to, you know, talk to planners, talk to accountants. I mean, do your little Google thing, but you need to talk to somebody to distill it down for your situation. Because when you read something online, it's not about your situation; it's about whatever situation they're presenting.
Mm-hmm.
So you need to talk to somebody. So there, that with that, I yield.
All right, Corey, bring us home.
Create a system of understanding. You're not going to know it all. You're not going to learn it all. Um, but come up with your foundation of understanding what works for you, right? And so, I say this a lot, but it's the nature of the human being. It's the nature of how we learn, and we're so prone to information that society throws at us, right? So we have this inside joke of Google accountants or Google business people, right, where they bag dive and just throw information, or somebody told them to do something, so they go ahead and do it with no understanding. And you can't make decisions without having an understanding. And so the question becomes, what do you need to learn? What do you need to learn? What do you need to put in place? How do things work? Right. And once you have that, as James says, and as you said earlier, that's when you're able to reach out to the professionals and lean on them. Um, doesn't matter, right? You just raise your hand and you reach out and you talk to professionals and you get plans, you get strategies. Now, that's not to say, here's the other thing to that. A lot of people lean on professionals for their advice and direction, right? But when they go and implement it and something ends up wrong, it now is the professional misguided them or didn't guide them correctly. The question becomes, did you A, really pay attention? B, did you implement the right approach, the right system at the right time? And when you noticed a ebb or a flow, did you reach back out to that professional to have a deeper conversation, because it can become an embarrassing moment because you felt that you may have dropped the ball and you wanted to see how things play out. Does that make sense? And so that's kind of the line. You know, when you start there, you can start to build yourself of a knowledge base internally and a resource of different professionals to help you either as individually or professionally.
Perfect. Perfect. That's the whole purpose of why I started this year is to get I wanted people to see the people I interact with and hear from them. And as you just said, we talk all the time. It's like I'm thinking about this, I'm thinking about that, and just to get a different perspective because there's so many ways to approach it. And at the end of the day, we're just trying to do what's best for that client and get them from A to B.
Mm-hmm.
And that's what we're trying
Mm-hmm.
to do. So with that, we're gonna close. I thank you both for jumping on today. So y'all were on this past Saturday, right? So we're off until
Yeah, until next week. Yeah, we just
Next
to
week.
you know,
next
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 week,
week.
man.
We got a topic coming up or
We got to
anything
have
like
our
that?
production meeting
yeah,
first.
we
You
have
know,
our
Okay, okay,
we have
production
our
meeting.
we
Okay.
probably, we always mix some tax with biz therapy. Oh, biztherapy.info for some business
Yes.
development and coaching support and tools and systems. Biztherapy.info. But we always
Okay.
mix it up. And what we've been doing too, Mark, is where we had you on it. We kind of like we may be able to exhale on weekly adventures or
Okay.
bi-weekly adventures of experiences that we run across
Uh-huh.
in business.
Absolutely.
So, which is like the meat on the bone, if you will.
Yeah, yeah, yeah.
We'll get a little
yeah,
more topic specific on when we start including other people and things of that nature. Yeah.
Nice, nice, nice,
yeah.
nice.
And I just thank you for having us on this
Yeah,
inaugural. Now,
absolutely.
what's the frequency of your show? What
Um, so the intent was to kind of do a first half of the year up until about May.
mm-hmm.
People kind of get missing summertime, let them breathe a little bit, jump back on right before Labor Day, run it up to November.
Yeah,
So plan was to go every other week. I'm gonna move up next week. So next week I'm gonna go back to back because 2 weeks from now is Valentine's Day. Figured nobody would probably jump on and watch the show.
yeah, I
So
understand.
yeah, Valentine's Day, right?
Yeah,
So pulling on up to next week, I've got another financial advisor coming on, Leonard Brooks. I don't know
oh,
if y'all
I
met
know
Leonard. Yeah,
Brooks.
you know Leonard. Yeah.
Yeah,
So hopefully have his bow tie on.
yeah,
Uh, so Leonard will be on next week. We're gonna talk about cash flow statement.
yes, sir.
We got a presentation. We're gonna go through that, and I know I've got you guys coming back on a couple more times. Big one we'll do with you all is 5 retirement mistakes that business owners make.
Whoa. So,
So
yep, I got
yeah, so
time.
I'm giving them time to do the homework.
I gotta go through my book.
Time to do the homework.
Beautiful, my friend. Well, congratulations.
Yep,
Glad we could be
yep,
a part.
yep. Thanks. So I put James's Hayward CPA up there, Biz Therapy. Corey, I'm gonna put you up there too. I should have put your website on there too. But Biz Therapy, Corey is great with a lot of the advice he helps us with our business owners and making them really understand their business and thinking through this thing, how they want it to work, not cutting corners, and it's beautiful. So again, thanks to both of you guys for jumping on this evening. And until next time, we'll see you. Appreciate it.
Thank you for having us.
All right, guys. Take care. Talk to you soon.
All right,
Like,
take
All
care.
right. All right. Bye.